Hello, today we're answering your top questions for investors, first-time home buyers, and sellers. Let's jump into it. Hi, I'm Dr. Roshawnna Novellis, a licensed realtor and mortgage loan originator, and I'm excited to answer your most common questions about real estate investing. So, the number one question that I'm asked is what I think is the best way to invest in real estate. And my favorite strategy is called the BRRRR method. So, that's when you buy, renovate, get a cash out, refinance, rent, and repeat. And so, this is what happens. So, say you buy a $500,000 house, you put 100,000 in for that renovation, then you do a cash out refinance, and through that refinance process the home appraises for 800,000. Typically when you do cash out refinances you can take up to 75, sometimes 80% of the value. So that excess value you can withdraw from that house and use it to invest in other properties, use it to fund your personal life, whatever you want to do. And because you're renting the property out, that renter's monthly rent, hopefully, is sufficient to pay not only the initial mortgage cost, but also the cost of that refinance. So they are paying all the carrying costs and fees for you to have been able to withdraw that money. At that point, the house becomes a long-term investment and you're looking at capital gains, but you're looking at capital gains from that higher price point. So you can get almost an immediate, ROI. So I would say immediate 3 to 6 months, sometimes a year, however long it takes you to do that renovation. And then you can keep the home for long term, maybe 5, 7, even 10 years before you sell it to get that second amount appreciation. The benefits are you don't have to wait until that 7 or 8 years to get that appreciation. And also, you are not a flipper. So, a lot of people think flipping is the only way to get that cash out, but you're not thinking about all the realtor fees, all the listing fees. If it is empty and not rented and the house is occurring monthly mortgage fees, you usually have to have your utilities on and the like. You are skipping all of those costs by doing it in this method. If you have more questions, reach out to me. I love to walk you through it. And so far, all the people in terms of real estate investors in my community and my friends and whatnot, they all have done this in a profitable way. So in my mind, it is the best way to do real estate investing. And so you might ask, next question, how do I finance these properties? So in general, you do need to have a down payment. So oftentimes investor loans are 30%, but there are some investors, and investors, I mean lending companies that will do an investment property loan for 25% or 20. Sometimes, but it really depends on your credit score. It doesn't necessarily have to be on your personal credit. Oftentimes, people in who buy investment properties close the deed in the name of their trust or quitclaim deed that document at closing. But there are tons of financial options, whether they be DSCR, cash flow, all kinds of things. And ways that you can buy an investment property as long as you have a down payment. You have to have a down payment. And if you want to talk to me about those, feel free to reach out to me. So, third question, how do interest rates affect that return on investment? So, typically, the higher the interest rate, the higher that monthly rent payment. And so, when you are doing an investor loan, you have an appraisal that looks at the average rents for that community, right? And most of the times you cannot get approved for an investor loan unless the rent roll, so the average rent rates in that community for that type of house, exceed the mortgage payment, right? And that's the mortgage payment, including principal, taxes, interest, HOA, everything that's in that mortgage payment, right? So the higher the interest rate, sometimes the more difficult it is to fit into that criteria. So you'll have to look at it there. A lot of times people will buy down that rate if you have additional capital, or find a house that has more of a rehab need to get that investor loan. There's lots of different scenarios, but what you want to do is to make sure that you do the math to understand how long you plan on having that home. What are the terms? A lot of investor loans have prepayment penalties, whether they be 1 year, 3 years, or 5 years, because the bank wants to make money off of there. The bank or the investor who's giving you the rest of the money wants to make money. So it's really important to pay attention to that prepayment penalty. And then that ROI again is based on not only that monthly payment, but what's more significant is the difference between that purchase price and the selling price. So if you use the BRRRR method that I mentioned before, you would have that initial cash out refinance, and then that long-term asset appreciation, as well as the cash flow from the monthly rentals if it is cash flow positive, right? And so when looking at the interest rates, it can dramatically impact these numbers. However, a lot of investors don't really, I would say, care, or it's less important because they're looking at the overall math. And typically, that cash out refinance from the renovation far outseeds, I'm talking about the gains, far outseeds any kind of interest rate issues. And that's why so many people try to flip or buy investment properties, because the cash from other calculation exceeds that monthly rental consideration. In addition, there are other ways to make money depending on how many doors. So a lot of people buy either duplexes, triplexes, and etc. I know my first investment property was a duplex in DC, and I initially, when I purchased the house, it's in Capitol Hill neighborhood. I rented out one side of the duplex, and then I lived in the other side. And so I used all the money that I received from the other side of the duplex to pay all the utilities, all the maintenance, all the upgrades the entire time I lived there. So it never came out of my budget, which was great. Then when I moved from DC to Atlanta, I rented out the other side that I was living in, and then the excess in rent, because I lived there for 7 years, and the neighborhood of Capitol Hill had appreciated significantly during that time that I lived there. The excess in cash flow was enough to pay my mortgage in Atlanta. So that was a situation that I was in the first couple years that I lived in Atlanta. And so this is the kind of thing that a lot of people aim for. And so instead of using that money to pay like on the mortgage on another property, a lot of people would use that cash flow or excess value to refinance, take that money out, and then buy another investment property. So do I think it's better to buy a single family or a multi-family home? And again, it depends. So with each person, it's a different personality, risk profile, job profile, and access to capital profile. However, I am a firm believer in diversification, right? So, how many properties can be managed, or doors with addresses can be managed by you or your property management team, right? And what feels great. So, I think if you don't want to deal with a lot of drama, like a duplex or triplex sounds great. However, some people jump all the way into apartment buildings, so it really depends on your risk tolerance, how much money you have in reserves, because you should have money in reserves for each home or each door that you have to deal with. The quality of the home, so how old is the home? What is the level of renovation? So do we think that all of the plumbing, or will last for 10 years? Those kinds of things affect the risk profile. But I think it's best to have a small number of doors, at least to get started with, so 2 to 3. But it really depends on the math and the ROI, because at the end of the day, it's all about the ROI, what you're going to get out, and not, which is more important than the number of doors. So those are the top questions for investors that I typically receive. Again, I'm not only a licensed realtor, but I'm a licensed mortgage loan officer at Nexa Mortgage, and we partner with over 270 sources of capital nationwide. So there's a solution. If there's a will, there's a way. And I love helping investors invest in real estate. So reach out to me if you have any questions. Sellers, this is for you. So, what are the top questions I receive from people who are considering selling? Number one, when is the best time to put my home on the market? So, typically, people are tired of being stuck in a house after a long, cold winter. So, the colder and longer it is, the more poppin' the spring real estate market is. And I remember this year I was looking every week at the number of new houses that were placed on the market throughout March and April, and it was like exponential. So it was awesome. However, when there's a lot more homes on the market, there can be a lot more competition. So that's something to keep in mind. Um, Also, there are people who have changes in life circumstances every single day. Every single day, a child is born. Every single day, someone proposes. Every single day, people get a new job. Every single day, people decide to move back home or to loved ones or family members. So, any of these types of events can trigger someone looking for a new home, and your home might be their perfect home. So, keep that in mind. It's not like you have to wait for spring in order to sell your house. That's just when a lot of other people do it, right? So, the next question is, do I need to renovate before listing my house? So it really depends on the current state of your house. So most realtors will give you a walkthrough before giving you any recommendation on listing. Typically in Atlanta, most people say replace the floors and paint, and everything else is optional. But again, it depends on how old your house is. Also, to keep in mind, most renovations don't get that 100% ROI, so you'll be losing money. So, my number one thing is to make sure the house is bright as possible. So, if you can replace all the light bulbs with the brightest LED lights, then when people walk in, it seems more welcoming. Lights have such a huge difference, right? So, lighting and paint and floors. However, you could do all this and people don't like the kitchen, right? So a lot of times you can have all these things done and people say no to a house because they don't like the layout of the kitchen or they don't like how the master bathroom looks, right? And this is whether you do a full renovation of them or not. So I've been in many top of the line homes that had custom renovations, and people don't like rust color appliances, right? Or they don't like form sinks, or they don't like sinks in the island. They don't want their sink by the window. It could be all kinds of things like this, right? And that buyer is just not the buyer for you. And so, whether or not you renovate, it depends on your market, depends on the current condition of the house, but just keep in mind that doesn't guarantee that the perfect buyer will love your choices in that renovation process. Realtors such as myself often look at comps in your neighborhood to figure out the prices that similar homes price for. However, sometimes that's not readily available. For instance, if you have a historic home and you're surrounded by all new construction, or if your home is 6,000 square feet and all the other homes in the neighborhood are 3,000 square feet, it can be hard to figure out that price. But the perfect price is that one that someone was willing to buy your house for, right? So oftentimes it has nothing to do with 3 months ago or last month or the neighborhood across the street. And a lot of sellers get caught up in that, or those custom bushes you put around the patio. Like, it's what that buyer is willing to pay for your house. That is the ultimate correct price. So us as realtors, we look at absorption rate, we look at the condition of other homes, we look at pricing, and then if it's a seller's or a buyer's market, to give you that recommendation of how to price your home. Right now, a lot of homes are on the market for about 4 months, but that's not every home, right? So If you're in a hot neighborhood and have a perfect layout, a lot of homes are still having bidding wars. I have been a part of many, many bidding wars, even though it's currently a buyer's market, because these certain houses are the ones that everybody wants, right? And so, oftentimes, as rates decrease as well, offers can increase, like if you're in a hot area. So I know when rates were in the threes and the fours, a lot of people were getting 50 offers on their home, right? And sellers had to sift through them. I know when I bought my last home, the seller told me they got 27 offers and they picked me because I had the best story, right? I didn't do the highest offer. I never do. I'm not about the dollar bill only. I don't think that's the final say in what matters. But I did write a whole narrative of why I deserve to buy the house, in which the sellers agreed on that narrative that I put together. So again, we use data, intuition, science, and then your math, right? What do you need to feel whole? All of these things are important as a seller when determining the right price for your home. Now we are moving on to those first time home buyers. So, how much money do you need to buy a house? So, it depends. The minimum for FHA is 3.5%. If you qualify for a VA loan, you can buy a house for 0% oftentimes. There's also a lot of times doctor's loans or different financing based on the profession. However, I'm a firm believer in the school of thought that you should have 20% down and a 15-year mortgage. I've always thought that, and it will put you in a good place for equity and to make sure that you don't have to pay your mortgage forever if you intend to live there forever, right? And so, but it's up to you and your philosophy. A lot of people want to put the minimum amount down and they're looking just to get that ROI and that appraised value before they move on. I definitely recommend that you do the math, talk to an expert to figure out if this amount is right for you. So the second question is that down payment all the money I need? And the answer is no. So oftentimes you as the buyer will have to also have 2 to 5% of the purchase price in cash ready to go. Why? You have to pay your own insurance, prorated taxes, sometimes lender fees, and now sometimes those realtor fees. So you want to make sure that you have cash available to pay the fees. That's like the transfer cost of buying a house, which are separate from the amount that goes towards your equity. Your equity is a percentage you own. All the other fees go towards the transaction and the title and the insurance and the realtor and the attorney. There's a lot of people that get paid when you buy a house. So keep that in mind as you budget for this new home. So, in terms of closing costs, who pays them? So it depends. Depending on the type of a loan, you can ask the seller to pay sometimes 3% or 6% of your loan amount. They don't have to say yes. But in a buyer's market, it's more common. Most of the homes that I have helped buyers purchase in Atlanta within the last year had some type of closing costs paid by the seller. At the low end, it's like $5,000, and the high end is one of those percentage numbers that I said before. And it depends on what's required or offered by the loan type, because different loan types have different maximum amount that seller concessions that can be offered. And it depends on what the seller is willing to offer, right? If they are in a cash crunch, they may not have that much money to offer or willingness to offer to you, right? So it's best to have all that money in reserves, and then when your realtor negotiates for you, to get the best deal that you can, because you can use that money to buy the furniture or any kind of custom music situation that you want in your house. So um however, you should have all the money that you need for all of your closing costs in advance. And if a seller provides you those seller concessions, they're essentially a credit on your statement and can be used to apply to those title insurance, home insurance, taxes, and the like, right? The last question is if it's better to get a pre-qualification or pre-approval. Pre-approval is always better because the lender has verified the information that you have provided to them. So oftentimes that's verifying your assets, your cash to close, your employment information, and the like. And that's going to give the seller more faith that they can accept your offer if it has that financing contingency. If you have that cash, you don't need either. You just have to have proof of funds, which is often the copy of the bank statement or a letter from the bank, which is better than a individual financial statement because you don't want all those people all up in your business. So, proof of funds from a financial institution or a pre-approval is best in order to purchase a house. And so those are the top questions that I have received recently from investors, sellers, and first-time home buyers. If you have any other questions, feel free to reach out to me.